What is going on, everybody? Happy Sunday. Hope everybody is enjoying the Father's Day weekend. It is absolutely gorgeous outside today. Hopefully everybody, maybe people got out golfing with their fathers and got to enjoy the day.
Yeah, if you booked it maybe 3 months ago in advance and you're able to snag that tee off time.
So we're going to wait for a few people to get on here, but we actually haven't done a live in a while. Just by, hey Rob, what's going on? Good to see you, buddy. We haven't done a live by ourselves for a while. And we've had a few videos drop since we actually did a live by ourselves. We wanted to go through a handful of different concepts and a few things that we had dropped in the last, I think, month or so. We've been having a lot of clients or a lot of special guests on, so we thought we'd break down a few of the concepts that we're seeing in the market right now. A lot of investors are focusing on these kind of niche products that we're offering at the moment, and we thought we'd bring them to everybody's attention. We'll wait for a few more people to get on here, though.
Yeah, I think a couple of cool products we talked about, not this Friday, but the Friday before. We were taking a look at alternate options for business for sale people who don't have a 2-year history, or for those who, maybe write down their income and don't necessarily show enough to qualify conventionally. We talked about the stated income and the declared income product, the difference between the two, and how we can use those, and we'll touch on those again today. And then on our last Friday, this past week here, we had our video release on development financing. So we're going to just touch on a couple cool products that we have for that on the private side, and then just on the conventional side as well too, and who we can use those for, maybe for some infill developers, for those who are buying up cheaper properties, single family, maybe some duplex, and are just kind of sitting on it and waiting to develop. There's a lot of provinces right now, or not provinces, but maybe provinces, but some cities that have made some changes to zoning. I know Ottawa is a big one. They've changed a lot of their zoning from 4 units to 8 to 12 units, I believe it is. So a lot of opportunity there to maybe pick up some undervalued properties, sit on it, and turn it into a larger multi-unit and cash out on the cash flow and some of that equity as well too.
For sure, yeah. No, a lot of the infill stuff we're seeing right now is from Ottawa. A lot of guys are taking advantage of not having to rezone the property you're looking to purchase and develop, which is obviously a huge amount of your hard costs to get the project moving. So it's interesting to see little pockets in Ontario and how investors are using different products to take advantage of the municipal laws that are changing. As we obviously everybody knows, but we have a issue with inventory at the moment. So one of two things are going to happen. Either the government's going to allow for open floodgates for developers to be able to develop a ton more real estate, or they're going to allow for higher density municipalities, which is what we're seeing now. We're seeing the garden suites being allowed in, the tiny houses in the back. So there's a lot of financing that is coming in that's kind of new to investors in general. So we thought we'd break down that for you, but let's get into infill or construction at the moment. So Scott, one of our business partners, had dropped a video and he was explaining essentially the process in land development and construction. Now, obviously there's a handful of different variables when it comes to doing a larger project versus a small project, but there's a handful of steps involved. One of them being the first step was acquisition, so purchasing the property itself. If it's a piece of land, that land value is going to need to be assessed. Once that value is assessed, depending on the lender you're looking to use, you're most likely about 50 to 65% loan to value on the actual purchase of the land. Currently, right now, there are some lenders out there who are offering 80% loan to value on the acquisition. It is like a promo until the end of June, but the most cost is upfront on purchasing.
Yeah, and that's not closing in June. We just have to get the application in June. So if you guys have some infill and you're looking for some, it is a private lender with some private construction financing. You want to take advantage of that 80% acquisition. Reach out, let us know. We can look at getting that application submitted in and try to solidify that 80% before the promo is over. But yeah, like Josh said, the biggest cost is just the acquisition. Two things that really determine that cost and acquisition is, or the one thing is really just how quickly are you looking to turn around that product? If you're going to buy the land and sit on it for a year or sit on it for a couple of years and wait till the value goes up and then maybe develop it down the road, you're going to be, on your lowest loan to values. The bank or the lenders want that property to be developed right away because it limits the options of them moving forward and having to try to potentially power sale a vacant land, which is going to be the most difficult situation for a lender to get rid of that land down the road. So they want you to be, having something in plan, having those building permits, having some architectural drawings, being ready to go on the development. That's going to get you your best loan to value on the acquisition.
Yeah, it's really interesting. So when you purchase the property itself, say you have like a month or two buffer in between acquisition and actually putting a shovel in the ground, you do have monthly payments, and those monthly payments are going to be interest-only payments usually, depending on the type of financing you have. Once you actually move into construction financing, things are structured a little bit differently. There is a Construction Lien Act, so you are able to set draws. So depending on the lender, you're able to either set as many draws as you would like, or the lender is going to set draws for you depending on a percentage of completion of your development. So usually, there's a cost involved for a draw. So you would say, look, I'm at 10% or 15%, I'm going to have my first draw. And they're going to require that you have a appraiser go out and just essentially assess where you're at in the process, give you a percentage of your completion, and then they'll issue you a draw. Now, there's a cost for that draw, but you're able to give you enough funds to be able to cover up until that point. We do recommend having at least 10-15% of your overall budget for construction in liquid cash. That's going to give you the ability to be able to make up any difference if the draw that they give you isn't enough to actually complete that phase of the construction. The Construction Lien Act requires at least 10% of every draw to be held at a lawyer's office. And then once you're closing, if you have that 10% and you weren't taking all of the financing, it can be almost as a rebate on the takeout financing.
Yeah, having that capital expenditure is going to be one of the things that the lender takes a look at when they're determining the full application. There's a few main things that we can touch on quick here. Obviously, the first one is just, how quickly are you looking to develop the property? Again, like I said, if you're going to sit on it for, a year or two, you're going to be at your lowest loan to value, and it's going to be a bit tougher to have a lender put that money out on the property potentially. The second is obviously just how much experience do you have, or are you, if you don't have as much experience as the bank would like, are you going to be hiring a GC or a general contractor to come and do the construction for you? Obviously the experience of yourself or the general contractor, if you have proven projects in the past that you've done that are very similar to what you're looking to do, that's going to look great in the eyes of the lender. So, like I said, if you are doing the project yourself, you don't have experience, reach out, let's have a conversation. Let's talk about some options that we can implement to help securitize your loan with the lender. If you are a contractor yourself and you do want to do the project yourself, the lender's definitely going to want to see your past experience and just get an understanding of what you've done in the past and your capacity to be able to complete the project. So just keep those things in mind. We have a whole list of items that the lender's going to want to take a look at and making sure that we have those checked off. One of the big things that they're going to want to see is just how much cash you have in the game and what's your equity standpoint in the project. One of the biggest mistakes that a lot of the newer developers or investors can do when they're doing construction development type projects is when they get that project to SPA and they get that accumulation of equity, or if they have equity in the project already, they take that equity out too quickly. And then there just isn't enough skin in the game for the developer, from the lender standpoint, and it can make it quite difficult moving forward to get competitive financing on the project. So again, just some things to keep in mind and have a conversation with us and somebody else that you may be working with on the financing side, and just making sure that you're taking the appropriate steps and you have all the details and information put together beforehand before moving forward with that packaging for finance.
Yeah, you're definitely going to want to ensure that your equity position in your property, whether that is cash or the actual value in the land itself, is there to be able to move forward with your project. Unfortunately, we do see some people get stuck when it comes to the construction financing aspect of it, just due to the liquidity that isn't there anymore due to refinance, maybe paying themselves or paying out some costs to get the project to SPA approval.
Yeah, and I mean, we get it. Obviously, once you start moving that project along and you see this huge number of equity available in the property, it's very tempting to go ahead and take that out. Obviously, you have a lot of costs moving forward. Just getting the architectural drawings, permits from the city, any rezoning changes that you may have to do, obviously all those carry an expense to them. So it can be quite tempting to take that equity out early, but there is a timing schedule that you would have to follow if you did want to take that equity out, and taking it out too early can quickly burn a project and make it very difficult to move forward or very expensive. One of the things that Scott talked about is approaching someone who already owns the land in an attempt to form a JV partnership and take advantage of any potential equity in the property already. So the Finley Mortgage team, we're working on a development in the Kitchener area, and that is how that developer moved forward. There was a piece of land that he was interested in. There was already a property on the land with an owner who had some experience in investing, and he approached them and said, I'm looking at buying your land. I want to put up a large development. I want to give you the opportunity to come in on the project. Let's move forward together. Since you already own the land, that equity is already in the project, in the game. You got some skin in there. It's going to be a lot easier to move forward and get that financing. Now, the biggest mistake that they made was they did actually take out some of that equity too early. So it did cause a little bit of difficulties getting that financing. They did have to take a look on the private side, but it can be a really great option if they're willing to move forward with you on that JV. Take advantage of the equity that's already in there. That's less capital that you have to bring to the table, less work that you have to do to be able to move that project along and get that equity built up. So it can be, a great opportunity for a joint venture and a really effective partnership.
Yeah, and depending on the value of the property, so there's a few different stages when you're purchasing land and moving it to construction financing. One being, once you buy the property, the as-is value of that asset. So if there's a building on it or whatever that is, the value of that at the moment. Then you're going to have some cost to be able to, you're going to want to refinance, pull some cash out, then you're going to want to do all the things you need to do to get site plan approval. And once you have site plan approval, that's the next major step of valuation in your project. So the value of your projects goes to the highest and best use case of that piece of land. And if your project is site plan approved for, say, a high density building, the value of that property significantly increases. And that is why, some people, investors, just do that. They just bring the project to site plan and they sell it to a developer. The next, obviously, once it's in site plan approval, you're going to want to get it. You want to get construction financing after that. But there's significant increases in value at certain points within the construction phase. Just understanding where that is, what you need to do to get there, is going to be super beneficial to you completing your project effectively. And that increase in value is quite significant depending on which municipality or which place you're actually investing in as well.
Yeah, it can be another way to be able to get into real estate flipping without flipping properties, is essentially just getting properties to SPA or getting vacant land to SPA and flipping it based on that value to a developer. So if you're well connected in the development world, or you know some people who are looking to get into the development space and are looking for land, getting that project in, obviously it's quite capital intensive to begin with, but if you have the capital, or if you're, we have the ability to get private financing or some sort of financing on that to get you there, can be quite lucrative and a really good way to make some, quite a large influx on your invested capital is getting that land to SBA and flipping it.
Yeah, one of the challenges obviously is being within the city requirements for zoning or rezoning. So understanding the process, maybe speaking to a city planner, depending on where you're at, and understanding what it's going to take to get there first. Sometimes those costs are upwards of $500,000 to $600,000 just to get it to where you need it to go. So it's not, it's very capital intensive when it comes to trying to do something like this. But most of the extremely wealthy developers I know focus on specifically that model, and it seems to be working, especially since they're not building out, they're building up. So, being able to rezone a property and offer a project to a developer is worth its weight in gold. Yeah,
definitely. And like Josh said, it does require quite a bit of capital. So having that JV partnership in place, like we talked about, and like Scott talked about, being able to take advantage of that, with the large capital or the large uptick in equity that comes out of getting that project to SPA, it's a much different scenario than going in on a duplex in Chatham for $250,000 and trying to split that equity between two people. where you're looking at maybe a few, $10,000 to $15,000. Now we're looking at a few $100,000, maybe even upwards of the millions of dollars if the project is large enough and you're able to sell it off to the right developer. That makes a lot more sense in terms of looking at a JV structure than looking at some of these smaller equity takeouts that you're really just kind of pinching funds and trying to make it work. So, a good option for those who are well into their career and looking for the next challenge. Obviously, I wouldn't necessarily recommend this to a new investor to go out and try to take on something this large. But for those who are, they've built up the portfolio, you're looking to get into something different, you have that capital, or you have the ability to maybe liquidate some properties or take out some equity, some existing equity, this could be the next type of venture that you're looking to get into and really start trying to scale your capital and that income.
And, it's an interesting concept. I've spoken to a few very large investors, and these guys, when you talk about cash for keys or developing, a lot of people underestimate the total cost of cash for keys. Maybe it's $10,000 a door. If you're buying large buildings, it's significant cost to be able to do that. And what most people don't understand is you don't need all of the capital for construction. You need a small percentage of the capital of the overall cost to be able to complete your project. Now, obviously, it is expensive to buy the land, but when calculating the numbers, if you can build something and then set your rent at market based off that, and then get CMHC financing or get the best financing on the market, the cash flow on that property, maybe more than what it would take to actually just buy an underperforming asset, buy it privately and refinance it and put it into a conventional loan. So, everybody that we've spoken to, or most of the guys that I've spoken to who get into the construction side of things, really enjoy it just due to the flexibility that it gives them when they can set rents on their multifamily properties.
Mm-hmm. And speaking of the CMHC, there are some CMHC construction projects out there where they have the ability to go quite high on the loan to value. Now, there are a lot of parameters that you do have to meet under these. Some of them may involve keeping your rents at a certain percent below market value. But again, if you're looking to get it into the development space, and the long goal is maybe not necessarily cash flow, but getting the project developed and then selling it off, that could be a strong asset to be able to get in, minimize some of the cost. Or if you're just looking to hold it long term, and it's a long term play for you, you're able to ride out the lower market rents for the required time, and then once that parameter is up, you can raise those rents. A couple different options there, but it does take. It's quite detailed. Takes a little bit more than our live, but if you are interested, definitely feel free to reach out and we can have a conversation about it.
For sure. I think as we see the infill space grow, I think you're going to start seeing a lot more investors moving into that construction model instead of the just acquisition of underperforming multifamilies. Even with multifamilies, we are seeing obviously an issue with conventional qualification just due to the net operating income on these properties now and the extreme value that has raised in such a short period of time. It's interesting to see, and Aaron and I are working on a few products right now to be able to help multifamily investors reposition assets to reduce the overall cost. But as we move into this new market that we're in, there's going to be challenges with many different types of investing, and I think one of those is going to be just purchasing, smaller multifamilies, duplexes, triplexes. They're not going to cash flow the same way that they were 2, 3, 4 years ago. So the construction side of things may be a more viable option if you can understand the concept of how to do it and you have a little bit more liquidity than just starting out in your investing career.
Yeah, I think Josh hit the nail right on the head there. It's the biggest challenge that we've started to see is with how hot the market is. These properties that are underperforming, they've had rents. I've seen rents that have been in place since like 1980, 1990. So, you're looking at almost 30 years, 31 years of sitting at, an underperforming value. So, and how hot the market is, a lot of the sellers, obviously want to sell their property for as high as possible. And there's a huge disconnect there. Obviously, they don't understand or maybe just don't necessarily care about how the financing gets qualified. And there are potentially some cash buyers out there who have the capital to be able to do it. But like Josh said, the discrepancy in how high the sales prices are and how low the NOI is on the property, it can be quite difficult to get financing on properties conventionally. When you have a property that's fully tenanted, right now there, is much more difficulty getting the tenants out. Private options can only go so far when it's, as difficult as it is to turn over those tenants. The last thing you want to do is get stuck in a private mortgage, hoping you're going to turn those rental incomes over, and at the end of the year, you're stuck refinancing back into that private. So picking up those underperforming single families, duplexes for on the cheaper side, and then look at developing those long terms into some more medium density, for let's say 5 unit, 6 unit, 8 to 10 unit type properties. There's a large uptick there. You're going to get the appreciation. You're going to get the increased cash flow. It's a way for you to get in there and set the rents right out of the gate, and increasing the amount of units that you have. So I think Josh is right. I think there's going to be a larger push towards this infill. We're already seeing the investors out there buying these at large scale. I think it's only a matter of time before we start to see more of these investors push to the development side and start sitting on these properties or develop them right away. I know I have a couple of clients who have been buying a lot in the Milton area, in the Barrie area, just kind of sitting on them. They don't even really care about the cash flow, but they know long-term play. They're going to convert these single-family homes into 8 units. They're going to not turn over, but be able to set all the rents. And it's, you going from an underperforming asset to a large multi that's cash flowing above market value on the rental income. So it's a strong play, in my opinion. Yeah,
there's really only going to be 2 options. Well, 3 options. One, you're extremely liquid. You have a lot of money to dump into a deal and you're okay with it until you can turn over tenants. 2 is going to be obviously closed privately, turn over tenants, refinance, which can be extremely expensive with attaining private financing. Or the last but not least, again, is just infill, just actually building it. And if you actually take a look at the total cost to borrow private financing, say it's $1 million or $2 million, it's a significant amount of upfront capital to do that, and then cash for keys versus having the liquid amount to be able just to build. It might make sense. Like we're going to have to, depending on obviously the size of the property, where you're buying it, how much capital you have, it's going to be probably quite the same. I mean, it's going to be a little bit of a variance depending on obviously your expectation and in regards to who you're going to have build the asset. But I think we're going to start seeing a major shift.
Yeah, I think so. I think it's a strong play. I think it makes sense in the market you're at. Eventually, if these prices stay hot enough, the lower end of the price points are going to start to get bought up. And as you start to turn these things over, I mean, we've already seen the Windsor market go from a 250, 280 market to, and around that 4, maybe even upwards of like 500,000, depending on which area of Windsor you're in. But, you're going to start to see these turnovers. And as the properties, like I said, as these lower price point properties start to get picked off and you start to get these medium price point properties, these rents on these medium price points are just the same as they are on these lowers. And it's just going to become harder and harder to get financing. And I think that presents that opportunity to go in, set the rents, develop the property, set the rents, and set yourself a little bit farther ahead where you would have been of just kind of trying to turn those over and burn it out or flip it out.
Yeah, I could definitely see smaller GCs specifically focusing on investors to build these properties as well. Mm-hmm. It's gonna be exciting to see it happen.
Yeah, definitely. I think one of the other videos we wanted to touch on quick was the one that we released last week, just on business for self, stated income versus the declared income. The really big product. I think an important product. One of the things that we've noticed is just the influx of investors who want to leave their 9-to-5, their salary, their guaranteed income job, and move to some sort of business for self position. And, what are the effects of that, and how does that affect you moving forward on qualifying? Obviously, if you are brand new into the industry and you just started, it's going to be tough to qualify for these products. At most on the stated income, what I think what we should do first is just take a step back and take a look at the difference between the stated income and a declared income. So a declared income is going to be a product that is limited to 65% loan to value. The declared income is your true declared income. This is a no bank statement, one day after business type operation, where you simply write and sign a declaration letter of how much income you're making with your business. There is no debt servicing. There is no GDS, TDS. It's simply the declared product. Like I said, it goes up to 65% loan to value. Now they do have the ability to allow you to put up to an 85% second behind there. So, vendor take back options could be a great option for this, getting in and putting just a 15% down. Great way to take advantage of that. there is no debt servicing, like we said. Rate is a little bit higher on this product simply because of the risk that it carries. Like we said, there's no debt servicing and there is no proof of income. So obviously there's a little bit more risk there to the lender. But I think the last time we talked to them, the rate was starting around 5.5%. That's going to be for your standard owner occupied property. And then as you move into like the rental markets, there is going to be a rate premium. So you're looking somewhere between 5.5 to maybe 6.5, 7%, depending on, they have multiple amortizations. You can get a 30 or 40 year. So again, if you want a 40-year AM, it's going to be a little premium in the rate there, but not a bad option when you consider some of the private money that is out there. Getting into an amortized mortgage with an actual bank, and have that ability to graduate over into a B or an A product afterwards can be a great alternative option to a private financing.
It's extremely powerful. And the idea of having it on your credit bureau and being able to show your consistent payments to increase your credit score, if you do have maybe bruised credit and that's why you maybe can't qualify for B financing or you don't have enough income to show, definitely a powerful product. The 65% loan to value is can be challenging depending on the liquidity situation that you personally have. But as Aaron said, you can get a second in place. So if you're looking for investment property, you possibly could just get a VTB and then come up with a smaller amount for the down payment. When it comes to the other business for self, they're solid products. Essentially, what you need is 6 to 12 month bank statements. Depending on the lender, they have either a 6-month bank statement or 12-month bank statement. The 12-month bank statement, what they do is they will have essentially an internal matrix, and they'll look at the specific type of work you do or the line of work you do, and they have a percentage of revenue based off of that line of work. So say, for example, you're a carpenter and you make less than $250,000. They can use 60% of your entire revenue for 12 months on your bank statements. Or as you increase revenue in your business bank account, though, the percentage that you can use decreases. So say you're making $1 million and you don't declare that on your taxes because you don't want to pay all of it, all the taxes to the government for the personal income, it is going to reduce slightly, maybe possibly 30%, but 30% of $1 million, still using $300,000 to qualify. These rates are decently aggressive. If it's an owner-occupied, we're in the high 2s right now. But if it's a rental property, we're in the mid 3s to high 3s, depending on where you're at and type of property. There's a 1% broker fee and a 1% lender fee. But this solution is really powerful, especially if you do the calculation and figure out how much am I going to pay in taxes personally if I pull this money out and show it on my T1 versus how much am I going to pay in interest over let's say 25 years of paying my mortgage off. It's significantly less taking a little bit of a higher rate and taking on the fees than it is to pay another $50,000, $60,000, $70,000 to the government every single year in taxes. So, this product is, again, super powerful. For anybody who hasn't been in business for less than 2 years, it could be decently useful if you are looking to maximize your overall qualification. Just don't show anything on paper.
Yeah, in either or. I mean, it can be used for those who just haven't been in business for 2 years, or you can be in business for 30 years. If you just consistently write your income down because you would rather pay less tax, again, this is a great option. For an example, a lawyer that I work with, he pays himself through his professional company. So, he's business for self in the eyes of a lender. He took a little bit of a haircut last year compared to what he showed in 2019. To get him back up to qualifying in the A, he was going to have to show an additional $50,000 on his income. So we're talking about a guy who was paying himself $250,000, paid himself $200,000 to get back up to that $250,000. He'd have to show $300,000 of income on his taxes. So we sat down, we looked at the numbers. How much interest was he going to pay on that mortgage over 1 year, over 3 years on the two different terms versus how much was he going to have to pay in taxes to be able to get that income back up to where it was going to have to be. And it was going to cost him about $20,000 extra to show the tax, pay the tax, get his income back up to where it would need to be to qualify on the A side. And for him, it just doesn't make sense to pay that additional tax every year. It was cheaper for him to pay the broker and the lender's fee, keep that little bit higher of a rate than it was to show the additional income and pay the tax on it. So, really does come down to doing the numbers, but in the majority of the circumstances that I've seen, it is cheaper to just take the B option, do the stated income product, and not pay the tax on paying yourself extra. Nothing wrong with writing down your income as long as you do it appropriately and within the limits. But for those who are, it's a great product. Business for sale, or we have owner occupied and rental products like Josh said. So if you're in that situation and you're finding it difficult to be able to qualify on the A side, or you're just getting into business and you're within your first year and you don't have those 2 years, reach out. Let's talk about what options we have and how we can use that gross revenue in your bank account moving forward to help you get in.
For sure, yeah. Powerful product. Something to really keep in mind is it is an uninsured product, meaning you need at least 20% down. The majority of the clients who are using this product are extremely cash heavy. They just don't show anything on paper. But for anybody who's watching right now, you do need at least 20% as a down payment for these products to qualify.
Yeah, definitely. They are a B lender, so they have really aggressive rental offsetting. 80% rental offsetting compared to the average on the A side, 50%. So there are benefits to going with the B side. And again, it really comes down to just running the numbers and whether or not it makes sense. And I think Josh would agree too. In most circumstances, it makes more sense when you compare dollar to dollar over the life of that term to go with the B option than it does to pay more in tax. So again, just reach out if you guys have any questions on that.
Yeah, guys, great options. There's never a no when it comes to real estate. It's just a matter of finding a solution or finding a product that works best for you and aligning your requirements with the bank's expectations. And if we can find a solution, then it works best for everybody. But I think that wraps it up for our live stream today, guys. We really appreciate everybody who comes on here and watches us and asks questions and reaches out. If you guys have any questions, again, please feel free to reach out to Aaron or myself. Our contact information is either down below, or you can just click on the email button on our Instagram to send us a message and find out more.
Yeah, definitely.
Thanks, guys. Take care.
Cheers.